Welcome to Earnings Central. In this video, we'll break down SAIC Applications' fourth quarter fiscal 2025 earnings. We'll cover key financial performance metrics and dig into insights from the earnings call. Alright, let's go. Starting with top-line revenue, the original estimate for Q4 was $1.82 billion. The company actually reported revenue of $1.84 billion, surpassing expectations by 1.1%. This quarterly revenue also marked a 5.7% increase compared to the $1.74 billion reported in the same quarter last year. Moving to adjusted earnings per share, the original estimate for Q4 was $2.19. The company actually reported an EPS of $2.57, crushing expectations by 17.4%. This result reflects a huge 79.7% increase compared to the $1.43 per share reported in the same quarter last year. Now let's dive into some additional performance metrics highlighted during the earnings call. First, let's look at SAIC's book-to-bill ratio, which came in at 0.9 for the fiscal year 2025. While slightly below the company's target of 1.2, management noted that a significant $1.8 billion contract win for system software lifecycle engineering came in just after the quarter closed. Had this been included, the trailing 12-month book-to-bill would have approached 1.0, and management remains confident in achieving their 1.2 target by the first half of FY26. The company delivered an adjusted EBITDA margin of 9.6% in the fourth quarter, which is particularly impressive considering the current contracting environment. For the full year, SAIC achieved a 9.5% EBITDA margin, exceeding their original guidance by 20 basis points. This outperformance was driven by strong program execution and lower incentive compensation expenses. Free cash flow was another bright spot, reaching $507 million for the full fiscal year 2025. This translates to just over $10 in free cash flow per share, and management expressed confidence in achieving their targets of $11 per share in FY26 and $12 per share in FY27, even if revenue conditions change. One of the most impressive statistics was the total submitted bids for FY25, which reached $28 billion. This significantly outpaced their initial plan of $22 billion in bids, demonstrating SAIC's aggressive approach to capturing new business opportunities, even during uncertain times. This robust bidding activity has resulted in a backlog of submitted bids exceeding $20 billion at year-end on a trailing 12-month basis. Management noted that over half of these submitted bids are expected to be awarded within the next 2 to 3 quarters, providing good visibility into future bookings. Looking ahead, SAIC provided FY26 guidance showing continued margin improvement. They're guiding to an EBITDA margin range of 9.4% to 9.6%, an increase of 10 basis points, with expectations for margins to continue improving into FY27 to a range of 9.5% to 9.7%. Now let's shift focus to some of the key insights and takeaways from the earnings call. Despite all the headlines about government efficiency initiatives and potential cutbacks, SAIC management emphasized that they've experienced minimal impact from recent executive orders and program cancellations. CEO Towns Whitley described the financial impact as nominal and noted that discussions with the administration have been productive. While they're preparing for potential changes, their base case doesn't assume any significant reduction in their addressable market. The company expects growth to accelerate in the second half of FY26. They're guiding to 1% to 3% growth in the first half of the year, accelerating to 2% to 4% in the second half. This cadence is primarily driven by the timing of recompete headwinds, which are more pronounced in the first quarter but ease throughout the year. An intriguing growth area highlighted during the call is SAIC's commercial revenue, which has grown significantly from less than $1 million in FY22 to approximately $45 million in FY25. The company has set a goal of reaching approximately $100 million in commercial revenue by FY28, with healthy margins consistent with commercial terms. Their top-selling commercial offering is DevSec Ops Sprints, providing ready-to-deploy software development teams. Management emphasized that on-contract growth continues to be a key driver of performance. With approximately 75% of their projected FY26 growth already in backlog, SAIC is not heavily reliant on new business revenue in the near term. Instead, they're focusing on growing existing contracts with even higher on-contract growth targets for FY26 compared to FY25. The company also highlighted the opportunity to transition more cost-plus contracts to fixed-price arrangements. Management believes a significant portion of their cost-plus portfolio could migrate to fixed price over time, which they view as a margin improvement opportunity. They noted their civilian business already has a good portion of fixed-price work, delivering higher margins, providing a proven model they can transfer to other parts of the organization. Finally, SAIC's leadership emphasized that focusing on mission-critical programs remains key to navigating the current environment. They noted that over two-thirds of their submit portfolio is in mission-critical, mission IT, and enterprise IT capabilities that directly support government missions. This concentration in essential areas is expected to provide durability as the government reassesses priorities. In conclusion, SAIC's fourth quarter and full-year FY25 results demonstrate solid performance and strategic positioning despite uncertainties in the government contracting landscape. By focusing on mission-critical work, pursuing on-contract growth, and expanding commercial opportunities, the company appears well-positioned to navigate the changing procurement environment while continuing to deliver value to shareholders. That wraps up our recap of Science Applications' fourth quarter fiscal 2025 earnings. If you found this recap helpful and want to stay on top of more earnings reports from other companies, don't forget to subscribe. We've got plenty more quick and easy breakdowns coming your way from Earnings Central.